It is early 2026. Equity indexes still trade near record highs, government officials repeat the word resilient, and central banks insist inflation is contained. Yet one chart from 1923 Weimar Germany now overlays the present with disturbing precision. The chart does not show panic, it shows acceleration. In 1923, German markets did not collapse first. They exploded upward. Stocks surged. Asset prices detached from wages. Paper wealth appeared to grow faster than reality. To the public, it looked like recovery. In truth, it was the final signal that the currency had failed. That same shape is visible again. The chart tracks the value of financial assets against the purchasing power of money. At first, the line rises gradually, then it steepens, then it goes vertical. That vertical phase is not prosperity. It is debasement becoming visible. In Weimar, the vertical move occurred after confidence broke, but before society understood what had happened. People believed they were getting richer. In reality, they were racing a collapsing unit of account. This is the mistake every generation repeats. Crashes are not sudden events. They are delayed recognitions. By the time panic appears, the damage is already complete. The chart stops being a warning and becomes confirmation. The reason the 1923 chart matters now is not symbolism. It is structure. The same inputs are present again: uncontrolled debt, currency dilution, asset inflation, and a population measuring wealth in a unit that is being destroyed. In Weimar, officials blamed speculation. They blamed hoarders. They blamed foreign pressure. None of it mattered. But the mechanism was already active. Printing accelerated. Confidence evaporated. Prices adjusted violently. The public did not react until purchasing power vanished. Today, the pattern repeats at scale. Debt expands faster than output. Currency units multiply faster than goods. Asset prices rise while wages lag. Charts go vertical. Officials call it growth. This is the final stage. The 1923 chart does not predict dates. It predicts behavior. It shows what happens when a system chooses dilution over discipline. It shows the exact moment paper wealth becomes meaningless. That moment always feels calm. Markets still function. Salaries are still clear. Prices are still quoted. The illusion of normality persists right up to the break. In Weimar, the crash was not when stocks fell. It was when money stopped working. The chart from 1923 shows that point clearly. And in 2026, the same shape is forming again. The mechanism has not changed. Only the scale has. The thesis: why crashes are visible before they happen. Crashes are not random shocks. They are mechanical outcomes that become visible long before they are acknowledged. The reason most people miss them is not lack of data. It is a misinterpretation. They watch prices instead of the unit those prices are measured in. Every financial collapse follows the same four-stage sequence because every system eventually collides with physical limits. Stage 1 is hard constraint and stability. Money is anchored to something real. Gold, silver, energy, or productive output enforces discipline. Credit expands slowly because settlement is costly. Prices reflect scarcity. Wealth accumulation aligns with productivity. Charts move sideways or gradually upward because the unit of account holds integrity. Stage 2 is expansion and abstraction. Success breeds leverage. Credit expands faster than production. Claims multiply. Financial instruments grow more complex. Asset prices rise faster than wages. The system appears healthy because growth is measured in nominal terms. This is where abstraction begins to hide decay. Stage 3 is distortion and loss of signal. Debt service overtakes productivity. Authorities intervene to stabilize markets. Currency creation accelerates. At this stage, charts stop reflecting economic health and start reflecting dilution. Asset prices rise not because assets are more valuable, but because the unit measuring them is weakening. Vertical charts appear. This is the warning phase. Stage 4 is the reset. The system cannot honor its promises in real terms. It does not announce failure. It manages it. Inflation replaces default. Controls replace transparency. Wealth transfers from holders of paper claims to holders of physical assets. The crash is not the fall in prices. It is the collapse of purchasing power. This is why the 1923 chart matters. In Weimar Germany, the vertical move was not prosperity. It was the currency dying in real time. Stocks rose because marks were being destroyed. The public misread the signal because they assumed the unit of account was stable. The same error is being repeated now. When charts go vertical in a debt-saturated system, it is not bullish. It is terminal. It signals that debasement has overtaken productivity. At that point, outcomes become mathematically inevitable. The crash is already embedded in the structure. The only remaining uncertainty is who understands it first. Once stage 4 begins, no policy choice can restore discipline. Printing can delay recognition. It cannot prevent resolution. Charts do not lie. They simply stop warning and start confirming. Historical proof. The rule of 3. When a chart turns vertical, the cause is never speculation alone. It is debasement overwhelming the measuring unit. History records this sequence repeatedly, and it does so with enough clarity that denial becomes the only remaining option. 3 cases: Rome, Weimar Germany, and the 1971 monetary break prove the mechanism beyond dispute. Rome is the first proof. Rome's power rested on a currency that worked. The silver denarius contained real metal of consistent weight. Soldiers accepted it for pay, merchants accepted it for trade, and the state accepted it for taxes. Trust existed because settlement was physical. The chart of Roman prosperity rose gradually, reflecting real expansion. Expansion created obligations. Legions multiplied, borders extended, roads, aqueducts, and administration expanded. Political loyalty became expensive. Taxation reached its limit. Rome faced the same constraint every empire eventually faces: reduce ambition or alter the money. Rome chose the money. Under Emperor Nero, the silver content of the denarius was reduced. The coin looked the same. Its face and legal value remained enforced. The reduction was presented as technical necessity. This was the first break between appearance and substance. From that moment forward, Roman charts began to lie. Debasement accelerated across generations. Each emperor reduced silver content further to fund immediate needs. By the 3rd century, Rome introduced the Antoninianus, officially valued at 2 denarii, while containing far less than double the silver. The chart of prices went vertical, not because goods became scarce overnight, but because the unit of account collapsed. Soldiers demanded more coins for the same service. Merchants raised prices to protect themselves. Long-term contracts vanished. Savings lost meaning. Rome did not collapse when debasement began. It collapsed when money stopped functioning as a store of value. At that point, enforcement replaced trust. Taxes were demanded in harder terms while wages were paid in debased coin. The economy fractured. Elites held land and grain. The public held paper promises disguised as money. The reset was unavoidable once the chart went vertical. Weimar Germany is the second proof. In 1923, Germany faced reparations totaling 132 billion gold marks. Gold marks were not symbolic. They represented fixed weight in metal. Germany did not possess the reserves required to pay. The debt was mathematically impossible to settle honestly. The state chose printing. At first, the chart looked positive. Industrial output appeared to recover. Stock prices surged. Paper wealth exploded upward. To the public, it looked like relief. In reality, it was debasement accelerating beyond control. As printing intensified, velocity followed. Holding cash became irrational. Prices rose not because of greed, but because the currency was collapsing. Bread prices moved from 160 marks to billions, then hundreds of billions. Savings were annihilated. Fixed incomes disappeared. The chart went vertical. This vertical movement was not growth. It was the final stage of currency failure. Assets were repriced continuously higher because the unit measuring them was dying. People believed they were getting richer while becoming poor in real terms. The population adapted logically. They spent it immediately. They converted marks into goods, land, and foreign currency. Hyperinflation was not chaos. It was arithmetic, enforcing reality. Those who understood the mechanism early survived. Insiders acquired factories and farmland for paper. Exporters held foreign settlements. Those who trusted savings accounts and wages were erased. The transfer was not ideological. It was mechanical. Weimar did not collapse when panic set in. It collapsed when confidence left quietly. The chart shows that moment clearly. The United States and Britain in 1971 formed the 3rd proof. After the Second World War, the Bretton Woods system anchored global currencies to the US dollar and the dollar to gold. This constraint imposed discipline. Claims could not expand infinitely because settlement was physical. By the late 1960s, obligations exceeded reserves. Foreign governments began demanding gold. The chart of gold reserves fell. Confidence fractured. On August 15, 1971, President Nixon closed the gold window. Bretton Woods ended. The final constraint was removed. The dollar became pure credit. The chart changed character immediately. Debt expanded exponentially. Financial markets exploded. Asset prices detached from wages. Productivity no longer anchored valuation. The vertical phase began, not in days, but over decades. This created the exorbitant privilege. The United States could issue claims without settlement. Deficits became permanent. Currency creation replaced discipline. Charts rose steadily, then steeply, as dilution accelerated. What followed was not stability, it was a distortion. Saving in currency became punishment. Speculation replaced production. Real wages stagnated while asset charts climbed. This was not accidental. It was the predictable outcome of removing the anchor. Across all 3 cases, the sequence is identical. First, money is trusted because it is constrained. Second, obligations exceed capacity. Third, the constraint is removed or diluted. Fourth, charts go vertical. Finally, the reset transfers wealth from paper holders to asset holders. Timing is the critical insight. Elites always recognize the vertical phase before the public. In Rome, senators held land and grain. In Weimar, insiders held factories and foreign currency. After 1971, asset owners benefited while wage earners absorbed inflation. Debasement never requires announcement. It operates silently. Inflation is not rising prices. Rising prices are evidence of currency decay. The real event is the collapse of the measuring stick. The chart does not cause the crash. It reveals it. The rule of three proves one fact beyond dispute. Once a system enters the vertical phase, reversal is impossible. No empire voluntarily restores discipline after debasement begins. Political pressure always favors printing over restraint. The modern system is not unique. It is simply larger. Rome's collapse was regional. Weimar's was national. The post-1971 system is global. Every pension, bond, and savings account is tied to an unanchored unit of account. This scale ensures synchronization. There is no external stabilizer left. When the chart turns vertical, the reset is already underway. The mechanism is not failing. It is completing its cycle. The modern trap. Reading the 2026 chart. The modern chart does not need interpretation. It needs recognition. The same signals that appeared in 1923 are present again. Scaled to a global system, debt expands faster than output. Asset prices detach from wages. Currency creation replaces restraint. The chart steepens while officials declare stability. This is the trap. In Weimar, the vertical move arrived after policymakers chose printing over default. In the modern system, the vertical move arrives after authorities choose liquidity over liquidation. The language has changed. The mechanism has not. Today's chart reflects three converging forces. First, sovereign debt has crossed the threshold where interest compounds faster than tax revenue. Once that line is crossed, new issuance funds old obligations. This is not a stimulus, it is a rollover dependency. The chart responds by steepening because currency supply must expand continuously to prevent default. Second, asset markets are structurally protected. Central banks intervene when prices fall, not when they rise. This asymmetry guarantees upward distortion. Risk is socialized downward, while gains remain private. The chart does not measure value creation. It measures protection intensity. Third, physical constraints are tightening. Energy, housing, infrastructure, and food face real limits. These limits do not appear in financial charts immediately. They appear in costs. When costs rise faster than incomes, purchasing power collapses even as asset prices soar. The chart looks healthy while society weakens. This is the defining feature of stage 4. The public misreads the signal because they assume the unit of account is stable. They see higher numbers and assume progress. In reality, the measuring stick is shrinking. Charts go vertical not because assets are improving, but because money is decaying. Policy responses deepen the trap. Rate cuts, balance sheet expansion, emergency facilities, and regulatory adjustments all feed the same outcome. They stabilize appearances while accelerating dilution. Each intervention pushes the chart higher and the currency lower. This is why timing matters. In 1923, the vertical phase was brief because the system was national. In the modern era, the vertical phase stretches longer because the system is global. Capital can rotate, settlement can be delayed, recognition can be postponed, but the destination does not change. The modern chart shows the same sequence: gradual rise, steepening curve, vertical acceleration. The final phase is not a crash in nominal terms. It is a collapse in real terms. Prices do not fall, money fails. This is why comparisons to past crashes miss the point. Equity drawdowns are not the reset. Currency debasement is. When purchasing power collapses, charts become irrelevant to daily life. Wealth measured in paper cannot buy stability. The trap closes when physical costs dominate behavior. Energy bills dictate consumption. Food prices dictate mobility. Housing costs dictate family formation. At that point, the chart no longer influences confidence. Survival does. Authorities will not admit this transition. They cannot. Admission would trigger the very behavior they are trying to prevent. Instead, they will continue to cite charts as proof of success. Rising markets will be presented as evidence of recovery. That presentation is the final signal. When charts are used to deny lived reality, the system has already failed. The gap between financial appearance and physical experience becomes politically and socially unstable. Controls follow, adjustments accelerate, the reset proceeds administratively. The 1923 chart did not predict panic. It predicted denial. The 2026 chart does the same. Once the vertical phase is reached, outcomes are mathematically inevitable. No policy adjustment can restore the measuring stick. No intervention can reverse dilution without collapsing the system it protects. The chart does not warn anymore. It confirms. The trap is believing that confirmation is strength. It is the end of the cycle. When charts stop warning, every monetary collapse ends the same way. Not with panic, but with redefinition. The public waits for the crash to appear as falling prices. That moment rarely comes. What arrives instead is a collapse of purchasing power. The chart does not fall, the currency does. This is the final misunderstanding. In 1923, German markets did not crash in nominal terms. They exploded upward. The reset did not occur when stocks collapsed. It occurred when money stopped functioning as a measuring tool. At that point, charts became meaningless to daily life. The same resolution now applies. The modern system has chosen debasement over default. That choice guarantees a transfer, not a destruction. Paper versus physical becomes the organizing principle. Currency, bonds, and financial claims retain numerical value, while energy, food, land, and infrastructure reclaim real pricing power. This is the reset. Those holding paper claims experience loss without confiscation. Those positioned in physical inputs experience repricing without warning. The mechanism does not reward foresight. It punishes exposure. The 1923 chart did not predict fear. It predicted inevitability. The 2026 chart does the same. Once charts stop warning and start confirming, the outcome is locked. No reform restores discipline. No policy reverses dilution. The system can only complete its cycle. Subscribe to Epoch Atlas to understand how these cycles repeat, how debasement operates, and why every monetary system ends the same way once the measuring stick breaks. This is not speculation. It is structure.